Hello all. Today we are going to learn about retained earnings. This is chapter 2 for SYJC students. Let us understand more on retained earnings. Every business organization have variations in their earnings. So it is a wise decision on the part of the company or organization to reserve a part of their earnings or profits for future purpose. The entire profit is not distributed to the shareholders. A part of the profit is retained in the form of reserve fund. These reserves are retained earnings of the company. The total retained earnings which are collected over the years are transferred to a fund called as reserve fund. This accumulated profits are reinvested in the business rather than distributed as dividend. So, the process of accumulating corporate profits and utilizing it in business is called as retained earnings. In simple words, a part of net profit which is not distributed to the shareholders as dividend is retained by the company in the form of reserve fund. So, the money kept in reserve fund the company cannot use. Hence, the company converts its reserve into bonus share capital and capitalizes its profit. This capitalization of profit by issue of bonus shares is known as plowing back of profit or self-financing. Bonus shares are issued free of cost to the equity shareholders out of the retained earnings. So a company, when it has its reserves, it tries to convert the reserves into capital. But a company cannot do so directly. It requires the permission of shareholders, which is decided in the meetings. Hence, the company gives the existing equity shareholders the bonus shares free of cost so that the equity shareholder is happy that he is getting something in return for dividend. So here the company is trying to avoid the outflow of funds by converting the profits into capital. The management can convert retained earnings into permanent share capital by issuing bonus shares. It is an important source of raising long-term capital. It is simple and cheapest method of raising finance. It is used by established companies. It is an internal source of finance. So, any business organization, the profit that it earns gives certain part of profit as dividend, it distributes it to its shareholders, and certain part of profit is retained. This profit which is retained is called as retained earnings, which is then later used for reinvesting in the business for future growth. So company uses its profit by retaining it and then reinvesting it in the business. So for the shareholders, it gives equity shares free of cost as bonus shares, thereby making the shareholders also happy by giving them equity shares, which is free of cost. Hence, it is said as internal source of finance for the business. Let us now understand the determinants of retained earnings. It will depend on the total earnings of the company. If more the earnings, the company can save more, hence more amount can be retained by the company. It also depends upon the attitude of top management. If the management allows to retain more money in the reserves, then more amount can be used for converting into capital. Next is taxation policy. If taxation policy of the government, if heavy taxes are levied, then the company cannot save much. Hence, the company cannot transfer more amount to the reserves. So, if the taxation policy is high, then reserves amount to be transferred becomes less for the company. Next is dividend policy. It is the policy of the board of directors as to how much amount is to be distributed as profit. A conservative dividend policy is required for accumulating the profit. So, any dividend policy which the company makes, if it has low rate of dividend, then the company can have more amount in reserves, as it is paying less dividend to the shareholders by keeping a low rate of dividend. Next is government control. A government is a regulatory body of economic system of a country. Its policies, rules and regulation ensures that company works as per its regulation. A company need to formulate its dividend policy in accordance with the rules and regulations framed by the government. So, taxation policy, dividend policy, government rules and regulation, policies affect the amount of profit to be transferred to the reserve. More amount transferred to the reserve means we have more capital to be used in business. If the company uses that capital by way of issuing bonus shares to the equity shareholder. Hence, these are some of the determinants of retained earnings which a company need to follow if it requires capital to be invested in business from the profits by way of retained earnings.